Good morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London, and these are the stories that set your agenda. A rally in Hong Kong tech stocks leads Asia markets higher with China and Japan closed. Bond traders price a Fed rate cut 1 month earlier in November, ahead of today's key US jobs report. Apple jumps after hours as it forecasts a return to sales growth. The iPhone maker announcing a $110 billion share buyback, the biggest in US history. Plus, in Europe, the earnings focus switches to banks, with French lenders in the spotlight. SocGen reporting a profit beat as equity traders help lift results. Crédit Agricole also coming in with a beat across the board for that French lender. First quarter net income, this is the redhead, coming in at 1.9 billion euros. Profits of 1.9 billion euros in the first quarter, comfortably above the estimates of 1.5 billion euros. In terms of the full year, Crédit Agricole seeing full year underlying net income at 6 billion euros. Revenues for the first quarter then 6.81 billion euros, above the estimates for Crédit Agricole. In terms of some of the other details around this earnings picture for Crédit Agricole, the investment banking side of the business also coming in with a beat. There's a beat in revenues, a beat in profits, and a beat in terms of the investment banking side of the business for Crédit Agricole. Operating expenses also lower than estimates. The stock is up 13% year to date. By the way, Jérôme Grivet, the Deputy CEO of Crédit Agricole, will be joining markets today and the team there in the next hour. That exclusive interview is at 7:15 a.m. So his thoughts on this beat that came through, of course, for the French lender. Meanwhile, SocGen also coming through with a beat, as we said in the headlines. The profit beat coming through, and it was the equities team doing the heavy lifting, with revenue there within that unit coming in and a gain of 3%. Not in line with its Wall Street rivals, but better than expected. SocGen first quarter net income, by the way, a comfortable beat, 680 million euros versus the estimates of 556 million euros. Fixed income sales and trading a little bit softer than expected. But again, it's the equities component of this business in the first quarter that did much of the heavy lifting, coming in revenue from that unit 870 million euros above the estimates. So decent beats for SocGen and Crédit Agricole, and we'll continue to cross and get the details on the reaction for that with those interviews, and a check, of course, on the stock pricing at 8 a.m. UK time. Let's check in on these markets then. The lift coming through from Apple, better than expected, particularly in this quarter. The outlook for this quarter consequential, and again, that record buyback, historic for the US, 110 billion US dollars coming through from Apple. So the tech optimism is back for these equity markets as we look ahead, of course, to the key jobs data out of the US, with the lens on the wage growth within that mix. European futures pointed to gains of 0.2%. The FTSE 100 at 8,200, looking to add 12 points at this stage. And the S&P, building on the gains of yesterday, is looking to add 0.2%. NASDAQ futures, of course, in positive territory on the back of the optimism coming through from Apple, looking to gains of 0.5%. Let's flip the board, cross-asset. Treasury's not trading. Japan is closed. But, of course, you did see a decent rundown in yields. Yields dropping around 9 basis points across the 10-year yield yesterday. The 2-year as well, getting some action and some focus there. In fact, it was the best 2-day rally for short-end treasuries since January. It's a 5 basis point move, I should say, on the 10-year, and a 9 basis point move on the 2-year yesterday. The Bloomberg dollar index is softer. That is helping as well, of course, in terms of the pressure across Asian currencies. Bloomberg dollar index currently down 0.1%. The Japanese yen, look at the strength there. The best gains that we've seen in terms of 3-week highs against the US dollar. Intervention, of course, is the expectation, the speculation. 152.95 on the Japanese yen. Brent, $83 a barrel, just up 0.2%. And gold at 2,308. A little bit of a gain there for the yellow metal, up 0.2 as well. Let's cross over to Avril Hong in Singapore for a check on those Asian markets. Avril.
Yeah, Tom. Asia stocks headed for gains today in a week where the Federal Reserve was not as hawkish as feared. Apple's outlook more recently lifting the mood. So we're seeing some gains, though not by much, on the South Korean and the Taiwanese gauges. Leading the pack is still the Hang Seng, underpinned by the Chinese tech names, the Alibabas, your Tencents, your Meituans, and the Hang Seng is on its longest winning streak since 2018. I'll get to whether this has legs in just a bit, but see the outlier here. These Nikkei futures in Singapore pointing to declines at the start of trade when markets return from the long weekend. I think it has something to do with what we're seeing on dollar yen. Flip the board. We did start the week, no thanks to a dovish BOJ, where we were at 160 at one point. That's quite a recovery this week, helped along by those intervention expectations and also the speculation that we already saw it this week, along with how the dollar slump. That recovery we're seeing on the yen is its best week against not just the dollar, the pound, the euro since December 2022. But what I wanted to highlight is how in the past 24 hours, the moves have been fairly steady. So they don't smell like intervention. More likely, this is the trimming of positions. Remember, we came into this week with massive shorts. That was the mood on the markets. Let's flip the board and take a look at what we're seeing on the Hong Kong stock gauges. This chart will show you they are well into overbought territory. I know this chart looks a bit like a tie-dye shirt, but the point is it really makes you wonder how much of this is the fear of missing out. Worth considering here, when you take a look at these Chinese tech valuations, despite the recent rally, they're still well below historical averages and well below that of their global peers. Speaking of which, let's take a look at the Apple suppliers, a couple that I wanted to highlight, including LG Innotek. That stock up about 5+% today. This is its 9th day of gains, and this is its best winning streak since it was listed 2008. This is a stock, of course, in South Korea that takes about 80% of its revenue from Apple. Not a bad way to end the week, Tom.
Avril Hong in Singapore with a check on the Asian markets, with a focus, of course, on Apple, and we continue the details around that story. Avril, thank you. Apple shares then jumping, of course, in late trading in the US after stronger than expected sales last quarter and a forecast for a return to growth in the current period. The iPhone maker also announcing the largest share buyback in US history. Let's get the details then from Matt Bloxham from Bloomberg Intelligence. Matt, what were the surprises then in these earnings?
Yeah, I think obviously the biggest surprise for everybody was the relative strength in China. You know, I think we've been well flagged for several months now that they were suffering in China, particularly on the iPhone. And so sales were down by about 8%. I think the street was looking for around 11% down. And Tim Cook was very clear on the call that the iPhone was doing better than people expected and that it took the number 1 and number 2 slots in terms of market share of smartphones in urban China last quarter. And that from his recent visit to China, you know, things were going very well. And time after time, analysts on the call asked him the same question. Is China really doing that well? This doesn't reconcile with what we've been seeing from our channel checks. And he wouldn't be drawn on it. He would just say that, you know, we're doing better than you think we are in China, and we're still confident about the mid to long-term outlook there.
Yeah, and they gave the outlook, or at least some details around the current quarter, but wouldn't break out the iPhone numbers from that, would they? In terms of what else investors are looking for from Apple in the weeks, months and quarters ahead then, Matt?
Yeah, so I think big picture, they're looking for the next big thing from Apple. They want this to be a top-line growth stock, and it clearly isn't right now. And even if it returns to growth next quarter, it's going to be 1 or 2%, not much. So 2 things coming up that are going to spark some new life, I think, into the story. One is the iPad refresh, I think next week, May 7th announcement. But bigger than that, in June, the Worldwide Developer Conference, where they'll reveal more about their generative AI plans. And again, lots of questions on the call yesterday about what those plans are. They wouldn't be drawn on it. But I think a couple of clues even in what Tim Cook said at the beginning of his prepared remarks was that they bring a kind of unique combination of hardware and software and services to the table. So I think it's going to be quite interesting. That may well be something that, both in terms of the service proposition, but also maybe the iPhone refresh later this year, there's going to be something a bit more exciting to think, well, maybe actually this is going to get more people upgrading iPhones, because the replacement cycle on smartphones generally, including iPhone, has been stretching, and they really need that to shrink again to get more sales momentum in that core product.
Really, really interesting. Matt Bloxham with the breakdown of the results and, of course, June and that AI strategy, as you say, really consequential. I love the fact that you point out that analysts and investors are saying we want this to be a growth stock again, because it's showing characteristics of being a value stock right now, isn't it, with the buybacks and the dividend from Apple. Matt Bloxham from Bloomberg Intelligence, thank you very much indeed. To the macro now, bond traders pulling forward expectations for the Federal Reserve's first full interest rate cut by a month from December to November. Next on the radar, of course, key US jobs data out later today. Bloomberg anchor Kriti Gupta is here with a preview. Kriti, what are you going to be scrutinising then from the jobs data?
It feels like the headline number is obviously going to be important, but it's the wage growth numbers that are extra extra important look. I think one of the key pieces of the inflationary story has been services inflation, specifically within the services inflation, the housing numbers and the wage inflation numbers. So I'm going to get really nerdy here, bear with me. But in the nitty gritty, things like ambulance drivers, how much they get paid,
that
medical services.
Yeah.
I really dove in deep. But things like that, because they're getting paid extra more, I should say extra, but more money than they traditionally have. And it's those kind of pieces of the labor market that are starting to see these bumps that are driving that services data and therefore the broader inflationary story. And that's really important when we put that into the context of the housing numbers as well, because housing also has a wealth effect when it comes to everyday consumers and how much they own, in addition to the stock market as well. Services are at the core of all of that, or wages, are at the core of all of that. What's also important is that the whole reason, the whole purpose, I don't need to tell you our audiences, but it's worth bearing in mind, the whole point of tackling inflation in the first place is to really tackle the affordability question as well, right? That Americans and their counterparts in other parts of the world need to be able to afford groceries, et cetera. But if real wages are catching up or even outpacing the inflationary measure, is that so much of an issue? And that's what a lot of people are talking about right now in terms of this resilience, in terms of this expansion. And that's where the headline number matters even more, because the average number pre-COVID was about 200,000. That's a very normal payrolls number pre-COVID. The whisper number is about 247. The economic estimates are about 240. So still, it is coming in quite hot. It's a marked drop from the numbers we got last month for the previous month, but it is still a higher estimate than we saw in the entire back half of last year. So if we're looking at this theme of is the labor market still hot? Is inflation still ticking up higher? The answer for a lot of people is yes, simply based off these economist estimates.
I wonder what you make of the market reaction then leading up to this and the repricing around the Fed, because there's been so much choppiness there. And we were talking not that long ago about a 2-year above 5%. Now you've seen that mark move lower in terms of yields. The market pricing in now a November cut. What do you make of the way that the market is adjusting to this and maybe how vulnerable it is to this data point today?
Yeah, well, it could, again, be a little bit of a nothing burger. And here's why I say that, which I know you're not supposed to say as a journalist, especially on television. But here's why I say that, because we've gotten so much of it front run earlier this week from the Federal Reserve, from the Treasury funding announcement as well. Really pay attention to what you're going to see in the yield curve, because remember, the kind of takeaway, at least from Chair Powell, that I had was in the quantitative tightening piece, right? You're keeping front-end yields really, really high, but you're kind of pulling back a little bit on the long end. So what that does is almost manipulate the curve in a little bit. Now, that isn't happening until the start of June, so we're still a month away, but you're going to see a lot of traders kind of front-run that. What does that then mean for a labor market if it does indeed come in hotter than the average pace of all of last year when inflation was actually coming down? That could be a concern. You're not going to see that in the long run. You're going to probably see that in the front end where perhaps 2-year yields, for example, do stay sustainably above 5%. And then the ripple effects are what matters. Does the stock market react more harshly to that bond market reaction? Does oil move with it? Does the dollar then kind of have that ripple effect? You see that dollar positioning really, really strong. So there's a bunch of pieces here, whereas the Fed swaps themselves may not actually move that much. You mentioned that they've moved that cut to November instead of December. There's still election risk. There's still a lot of data between now and then. That's in the wind.
OK, Kriti Gupta, Markets Today anchor, of course, setting us up really nicely with a preview of the non-farm payrolls data out of the US, scrutinising, of course, the earnings component within that. The number expected top line to be 240,000. That is the forecast. Here's what else to be thinking about today, then, above and beyond the jobs data out of the US. 7:45 a.m. UK time. French industrial production data will be coming out, so giving you a bit more colour in terms of the health of the French economy. 9 a.m. meanwhile, UK time. Deutsche Bank's rate decision as well. So another central bank rate decision later today, 9 a.m. UK time. And today, HSBC's AGM with a focus on what they're going to do and the decision around the bonus cap. Will they align with UK government policy? That's really interesting, given that Goldman Sachs has gone in that direction. Coming up, oil is set for the biggest weekly drop since February on signs of easing geopolitical risks in the Middle East and weakening across the fuel markets. All the details across the oil space next, and the analysis. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday. Macquarie's earnings have missed estimates as a plunge in profit from its commodities and global markets business dragged on performance. The unit had become a major profit engine in recent years for the Australian firm. The division's contribution fell 47% on the prior year as energy shocks from wars in Ukraine and the Middle East subsided. Gazprom Group has posted its first annual loss since 1999, driven by falling shipments to Europe and lower gas prices. The Russian state-controlled gas giant reported a loss of $6.8 billion. Gas flows to Europe have been restricted, of course, amid the Kremlin's retaliation for Western support of Ukraine after Russia's invasion in 2022. Let's check in on the oil markets as well, because there's a lot of factors to think about that have played through the oil markets in the last few days in terms of inventories in the US, stockpiles, the question marks, of course, around a potential ceasefire in the Middle East. Brent is actually down in the last 30 days, around 8%, close to 8%. It's currently at $83.93, as you can see in the session, up just over 0.3%. WTI remains below $80 a barrel at $79.20, but up in the session 0.3%. Let's unpack some of this and bring in Bloomberg's Stephen Stupczynski, our senior energy reporter, joining us out of Singapore. Stephen, walk us through what we've been seeing in these oil markets and how markets, investors have started to recalibrate their views on oil.
Yeah, I mean, a few weeks ago, I think we had hit a peak for oil after Iran attacked Israel directly and then Israel, of course, had the counteroffensive there, and you saw prices kind of jump up above $90 for Brent. But since then, there's been a pretty steady decline, down roughly 10%, and that's largely driven, I think, by that war risk kind of receding. The U.S. has stood pretty firm, saying that, asking Israel and urging them not to further retaliate against Iran, which would, potentially risk that kind of spiraling into a proxy war between Iran and the United States and affect, at a worst case scenario, oil production in the region as well as flows through the Strait of Hormuz, which makes up about 30% of oil trade, goes through that key conduit. Now, because that risk has receded, you've seen prices really kind of deflate. So that's the one thing. That's a war risk. The other thing, of course, as well, is the fundamentals. We've had some pretty bearish data out of the United States, larger than normal gains in oil product inventories in the U.S. At the same time, there's indications that gasoline demand and demand for products aren't terribly strong right now in the United States, leading up to the peak driving season. When summer starts, everyone goes on a trip. So there's some fear that maybe there won't be a lot of demand there in the United States. And as well, Chinese demand hasn't been as resilient. While it is growing, and it hasn't been as resilient as some had been expecting. That's sort of a more complicated picture because their factory data has been just recently released, and that had showed a positive economic increase two months in a row of positive factory data out of China. But that all being said, the picture is showing that maybe we really aren't in a march to $100 Brent. Maybe we're going to be playing in the $80 range for a little while.
OK, the $80 range rather than the $100 that some analysts, of course, had forecast for this year. Stephen, what are the other catalysts you're looking for? There's a summer season, as you mentioned, in the US. And where does OPEC Plus stand at this point?
Yeah, I mean, certainly there's a big question as where is U.S. gasoline demand going to be? So that, I don't have the crystal ball. It's hard to say how that will pan out. But I think once that data starts to come in, you could potentially see prices rise or fall, depending on if it's more than what analysts were expecting. Now, when you talk about OPEC Plus, that is the next big question. They've held production cuts steady through the second quarter. What are they going to do for the third quarter? If oil prices are kind of sliding, if we aren't so worried about an oil deficit in the market, then maybe OPEC Plus keeps these cuts going into the third quarter. There's also a matter of compliance. Is Iraq going to hit their production cuts? They've struggled to do so in the past, but they have, to a degree, committed to reducing their production. As well, Russian oil output has been a bit more resilient than I think some in the market were expecting. Is that going to be reduced, either because of the war in Ukraine? There have been drone attacks on some of the refining facilities as well. Will they reduce it to hit OPEC Plus targets? So I think all that together, to summarize, it is a question: will these cuts continue through the third quarter? If it does, then you could see prices kind of remain kind of higher in this $80 range. If they don't continue them, then we could see prices kind of fall and the market be flooded with more oil.
OK, Bloomberg's Stephen Stupczynski with the granular detail on these oil markets for us. Stephen, thank you very much indeed. Coming up, we're going to discuss how polysilicon supply chains are causing a solar trade war. Our weekly deep dive into the green energy transition is next. This is Bloomberg. Welcome back. Time now for our weekly deep dive into the green energy transition. This week, we're going to look at polysilicon, the raw material used in most solar modules, and why US-China trade tensions have made it a hot commodity. For more on this, I'm joined by Jenny Chase, specialist in Bloomberg's NEF solar team. Jenny, why are governments supporting polysilicon production outside of China then?
Well, mostly it's the US that's supporting polysilicon production outside China. Last month, the US awarded a $256 million tax credit to a company called Highland Materials to build the first greenfield polysilicon plant outside China for years. And the reason that the US government is doing this is that China makes about 95% of the world's polysilicon, mostly not in the Xinjiang province, where there are human rights concerns and therefore there are restrictions on exporting it to the US. But clearly, this is something of a dependence worldwide, that China makes 95% of the stuff.
And there's Highland Materials then, offering a technology edge over the heavyweights in the industry. Talk to us about the positioning amongst some of these different players then.
OK, so polysilicon has two major production methods. There's a Siemens process, which is currently about 85% of the market, and fluidized bed reactor, which is quite a similar process, actually. Now, Highland Materials, which I should just say is a company that in 18 years of covering solar, I have never heard of. So I was a bit surprised to see that on the list. Highland Materials says it doesn't do either of these. It doesn't do Siemens or fluidized bed reactor. What it sounds like from its website is that it's probably doing a technology called upgraded metallurgical silicon, or similar to what we used to call that. Which is interesting because that has never been successful. This is kind of a long shot. It's supposed to be a low energy, low capex alternative to fluidized bed reactor and Siemens process polysilicon. But I would stress that this has never really worked before, and it has been quite extensively invested in. So who knows what's going on there?
OK, and are there other dynamics then supporting production outside of China at this point?
Well, there are, because in 2022, the US brought in something called the Uyghur Forced Labour Prevention Act, which means that polysilicon used in modules that goes to the US needs to have paperwork proving that its entire supply chain is not in Xinjiang. The result of this is that polysilicon from outside China currently trades at a premium of about 3 times that of polysilicon from in China. So it's about $8 a kilogram from China and about $22 a kilogram from elsewhere. And so there is an incentive to manufacture outside China, but it probably isn't sufficient to set up entire capex-intensive heavy chemicals plants outside China. This is the first announcement in years.
OK, Jenny Chase, thank you very much indeed from Bloomberg's NEF team, with a focus on the changes around polysilicon production and the consequences for the broader solar industry. Really interesting deep dive. Thank you, Jenny. Coming up, the Spanish Puig dynasty is launching what's set to be the biggest European listing this year. We're going to have the details next. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. Happy Friday. I'm Tom Mackenzie in London. These are the stories that set your agenda. A rally in Hong Kong tech stocks leads Asian markets higher. Japan and China are closed. Bond traders price a Fed rate cut 1 month earlier in November, ahead of today's key US jobs report. Apple jumps after hours as it forecasts a return to sales growth. The iPhone maker announcing a $110 billion share buyback. That is the biggest in US history. In Europe, French lenders are in the earnings spotlight. SocGen reports a profit beat as equities traders lift results. Credit Agricole records a big beat in net income. Some optimism coming through on the earnings front from the bank space and, of course, Apple within technology. We check in on these markets then, and that is filtering across in terms of the futures story as well. Very decent session, as we said, over in Asia. European futures looking to add 0.2%. FTSE 100 futures here in the UK, 8,202, looking to add 14 points so far. 5,100 is what's been flagged on the S&P futures, looking to add 0.2% after the gains of yesterday. And NASDAQ futures, of course, in focus, given the optimism around Apple, that record buyback, currently pointing to gains of 0.6%. Let's look cross-asset then. Japanese markets, of course, are closed, so we're not getting a print on treasuries. The dollar, though, is softer in the session, down 0.1%. That is playing into what you're seeing in Japan, where the Japanese yen is at a 3-week high, 152 now, 92. Long gone are the days, it seems, we were at 160. Not that far away, was it? But the intervention speculation continues. Currently, that currency is up 0.5%. Brent, $83 a barrel, just below 84. We may cross that level, currently up 0.3%. And gold, 2,307, just popping 0.1% on the yellow metal. Let's get to the earnings story then, with the spotlight on European lenders, French banks in particular. SocGen reporting profits, as we said, ahead of estimates as equities traders help lift results. Also in France, Crédit Agricole recording a big beat in net income. For the analysis, we are joined by Bloomberg's Charlie Wells. Charlie, how did SocGen pull this off then?
Yeah, their stock hasn't been performing as well as other banks in Europe. So it's up about 7% this year, broadly on the, Stock 600 index.
It's been a laggard, hasn't it?
It's been a little bit of a laggard, but they got a boost here from equities trading, so an increase of 3%. But look, there's still some softness at this bank. So the retail banking unit, what we are seeing, they took some wrong way hedges, and that's been weighing on net interest income in that retail unit. And this kind of ties into their CEO's push to try to streamline the bank. They announced 900 job cuts earlier this year. So there's a lot of pressure on this bank, but this beat is going to alleviate at least some of that.
Yeah, the scrutiny is not moving away from SocGen in the near term, isn't it? But as you say, a bit of relief, presumably, for the executive team there. When it comes to Crédit Agricole, the top lines seem to be all positive for this bank. Give us the details on Crédit Agricole then.
So what was really helpful here was their large customer unit, and that also houses their investment bank. And so that gave them a real boost. We saw revenue there hit a record 2.3 billion euros. So that's going to be really positive. And now when you look back, we've got Crédit Agricole, the second largest bank, they got a beat. You got Société Générale, the third largest bank, they got a beat. So this morning is a very good morning for these French banks because the largest bank, BNP, also had a beat. So this kind of rounds them all out, tells a very positive story about French banking.
And that's
right
a French story. So we look at the CAC 40 at 8 o'clock and see how much of a lift is going to come through on that index on the back of these earnings. Taking a step back then, we've had a number, of course, of European banks coming through this week. What is your kind of top-line view in terms of the health of the European banking sector at this point?
It's been a really positive story this year across the continent. So when you look at that Stock 600 banks index, as I mentioned, up 16%. I mean, that is the industry that is doing well, incredibly well, beating all other industries on that index. And when you look back to 2020, the banks index is up 120%. So, that's a really positive story. And then looking at some of these other banks, I mean, Barclays got a beat. They were aided by stock traders. Deutsche Bank, they got a beat. They were aided by investment bankers. And HSBC, of course, we had that shock retirement, but also that $3 billion buyback. So this is a story that investors are really liking so far.
Charlie Wells, thank you very much indeed. An important moment for these European banks and some optimism in terms of the earnings story that is coming through. Charlie Wells with the details. Thank you very much indeed. A reminder, Jérôme Rivet, the Deputy CEO of Crédit Agricole, is going to be joining the Markets Today team in the next hour. That exclusive interview at 7:15 a.m. Tune in for that. Now, some of London's top bankers might soon have a paycheck that looks at least a bit more like the bonus-heavy packages of their New York counterparts, with Goldman Sachs paving the way. Shareholders at top UK banks set to vote on pay practices at their upcoming AGMs. The decisions comes, of course, after a cap on bankers' bonuses was scrapped to make London more appealing.
Wall Street-sized paydays may soon be coming to the City of London. It's been 6 months since the UK lifted a cap on bonuses that limited them to 2 times a banker's base salary, a legacy of the financial crisis, and a far cry from the millions that top deal makers and traders in New York can make. Now it's up to the shareholders at banks, including HSBC and Barclays, which will be putting the matter to votes at AGMs. If the proposals pass, the process of rejigging compensation could begin in time for next year's bonus season, which Wall Streeters have historically counted on to pay for elite private schools, luxury holiday homes, and the most expensive cars. The cap was scrapped by UK officials battling to maintain London's preeminent position as a global financial centre in post-Brexit Britain. Overhauling pay could have consequences at home and abroad. Senior UK bankers who had fixed salaries increased to circumvent the cap could now potentially face reductions. And European rivals could find themselves at a disadvantage when hiring.
It's certainly a concern when regulations in the US and the UK, where we are active in a number of our businesses, start to move in a way that places European competitors at a disadvantage.
Top proxy advisors are recommending that HSBC and Barclays shareholders approve the measures, a sign they're likely to pass. No longer will city rainmakers feel like the poor cousins of Wall Street.
OK, Deutsche Bank, meanwhile, is planning to double the assets it manages for rich families in Southeast Asia and the Middle East over the next 5 years. The lender's global private banking head says high net worth individuals in Saudi and UAE are increasingly keen to invest in Southeast Asia and Hong Kong and vice versa. Deutsche currently manages about $650 billion for rich clients around the world. Now, Spanish dynasty, the Puig family, is launching what's set to be Europe's biggest listing this year. Shares in the beauty and fragrance firm start trading today after raising €2.6 billion. Let's bring in Bloomberg's Manuel Baigorri then for the details. Manuel, what are you expecting from the IPO launch then?
Hello, Tom. Major event taking place today with what's going to be the largest IPO in Europe this year, with Puig starting trading. I mean, it's a phenomenal company. We've been covering this company very thoroughly in the past few months since news emerged of their considerations for an IPO this year. I mean, it's going to be big news, right? Because, I mean, the market is really hungry for big and successful IPOs. Investors need good news in a way to bring back confidence. And I mean, there's been a huge demand for this IPO. I mean, it's been priced at the top end of the range. And it's a very, very formidable, very solid company with lots of growth and very profitable, with huge and well-known brands globally behind it. So it's a company that should do well in the IPO. We'll see soon how it performs today, but definitely a lot of expectations set in this listing today.
OK, Manuel, you also answered a very important question for us as well, which is how to pronounce the name of this company. Puig, then, is it? You seem to have said Puig. Manuel, did this signal then a rebound in IPO listings in Europe and elsewhere? I know you scrutinised that story as well.
Yes, Tom. I mean, it's a big question mark yet in the horizon. Definitely, it's looking better, particularly in Europe. We've seen some signs of improvement in the IPO market this year. Today is going to be a big test. In the US as well, we've seen a couple very sizable IPOs taking place recently as well. I think here in Asia, market sentiment remains more challenged, definitely more muted in venues such as Hong Kong, where it's still a far cry from the boom years, call it like 3, 4, 5 years ago. So it's still a lot of kind of like challenging, and a lot of unforeseen challenges out there. But definitely Europe and the US is starting to look a lot better. And I think Puig IPO today will be a good sign on where things stand. I think of the three, Asia remains the more challenge of them.
OK, really, really interesting. Manuel Baigorri on the details around the IPO markets for Europe. And that ties into the banking story and the earnings story that we were talking about earlier. And, of course, that IPO for Puig and what that tells us about demand. Manuel, thank you very much indeed. Some other stories making the news then this Friday. Sony and Apollo are said to have made a $26 billion bid for media giant Paramount Global. Sources say the offer is a non-binding expression of interest and would be an all-cash offer, plus the assumption of debt. Paramount has also been weighing a merger proposal from David Ellison, the head of Skydance Media. Hong Kong securities watchdog has launched criminal proceedings against hedge fund Saganti Capital Management. Its founder Simon Sadler and a former trader in one of the most high-profile financial prosecutions in the city. The SFC alleges insider dealing in shares of a listed company before a 2017 block trade. The company and Sadler deny the allegations. Coming up, the first results trickling in from last night's UK elections. What's the takeaway then so far for Rishi Sunak's embattled Conservative Party? That conversation is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the first results from the UK local elections are streaming in, with the opposition Labour Party making gains. Labour has also won a parliamentary by-election from the Conservatives in another blow for Rishi Sunak's leadership. Let's bring in then Lizzie Burden, our UK correspondent. Lizzie, some were girding for a shellacking for the Tory party overnight. Is that what's transpired? How bad was it for the Tories?
Well, we're still waiting for many of the results, and they'll keep trickling in all the way till Sunday. The polls closed at 10 p.m. last night. One, as you mentioned, is a key result. Keir Starmer, the opposition Labour leader, says it's the most important result today, and that's Blackpool South. So there was a parliamentary by-election after Scott Benton, the Tory MP, stood down following a lobbying scandal. And the swing from the Conservatives to Labour is 26%. It's the third largest by-election swing since the Second World War. And not only that, but the Conservatives have to contend with Reform, this right-wing group that's risen up recently. It was easily their best performance in a parliamentary by-election ever. So the Conservatives are having to look over both shoulders at this time, the right and the left.
Yeah, it's Reform getting 17% or something around those levels in Blackpool. So Keir Starmer hailing that result in Blackpool, which was a by-election, as you say. What signals do we get about the fortunes of the Labour Party, then, from the elections that have transpired over the last 24 hours and how it sets up the Labour Party in this key general election year? Yeah, well, obviously, the more that the Conservatives lose seats, the more it reinforces the view that Starmer is on the path to Downing Street. You've had the local elections expert Robert Hayward, the Tory peer even, predicting losses of about 400 seats in these local elections. The Chancellor, Jeremy Hunt, on Wednesday, preparing everybody for saying he was braced for significant losses himself, bit of expectations management. Another polling expert, the national treasure here in the UK, Professor John Curtis, has actually said that these results for Labour are not like before the 1997 landslide for Tony Blair, when actually you saw much more success at the local elections than you're seeing under Starmer today. Actually, this is more like last year's results. So it's not the big bloodbath that some had feared in the Conservative Party, but it won't give the comfort, I'm sure, to Rishi Sunak nonetheless. OK, that's really interesting in terms of the nuance around these results and how they compare to last year and leading up, of course, to Tony Blair's victory in 1997. Any results, you point out that we don't get the full picture until Sunday. Any results that you're going to be scrutinising between now and then that are going to be particularly significant? Yeah, the two key mayoral races are Andy Street in the West Midlands and Ben Houchin in Tees Valley. Now, actually, it's not by any means definite that they're going to lose. They're both Conservatives. They're both Conservatives, and Labour's trying to take those seats because these are in Labour-facing areas. They really represent the bar of success if the Conservatives can hold on to these seats in Labour-facing areas. Houchin's team are actually projecting quite a lot of confidence at this point. And of the two, Street is perhaps more at risk because of Rishi Sunak, the Prime Minister's decision to cancel the high-speed rail link from Manchester to Birmingham. You remember that dramatic decision at Conservative Party conference in the autumn. So we're going to await those results. Houchin comes this afternoon and we get Street tomorrow. And Andy Street spoke out pretty forcefully against that decision, didn't he, around HS2. Before we let you go, Lizzie, there had been a lot of speculation in the halls of Westminster leading up to this that if the Tories did particularly badly, Rishi Sunak would genuinely be vulnerable to a run within the party. Has that been... It's early days, and there's that caveat. We still don't have the full results. We're far from that. But do we have a sense as to whether or not the Prime Minister is safe in his role right now as leader of this Tory party in the run-up to those general elections?
Look, you're never safe as the leader of the Conservative Party. The plotting has been going on for months in the run-up to these local elections. This, the moment when the rebels wanted to show that only a change of leader could make sure that they're not completely wiped out at the general election, that it's not an extinction event. But what you could see is that Sunak just claws his way through, even if they lose roughly half of the just over 1,000 seats that they're defending in the local elections. If they just hold on to those 2 mayors as well, he could make it through all the way to the general. And the Conservatives, bear in mind, have already had Boris Johnson and Liz Truss and Rishi Sunak. It would be quite a difficult thing for the population to have to digest another Tory leader before the general.
OK, Lizzie Burden, our UK correspondent, thank you very much indeed with the details around the vote and the results that are continuing to come through and the implications, of course, for the Prime Minister, Rishi Sunak, and his party. Now to some other stories making news this Friday. Columbia University says 13 of the 44 people who occupied and barricaded themselves inside the school's Hamilton Hall had no affiliation with the institution. The activists' demands include divestment from Israel and an end to academic ties with the country. Yesterday, New York City Mayor Eric Adams said outsiders accounted for about a third of the 112 people arrested in a crackdown that occurred at Columbia on Tuesday evening. Turkey, meanwhile, is halting all trade with Israel over what it calls the worsening humanitarian tragedy in Palestine. Israel's imports from Turkey reached $4.6 billion last year and include machinery, fuel, fresh produce and food. Israel's foreign minister used a post on X to call the ban the behaviour of a dictator. South African President Cyril Ramaphosa has claimed some notable achievements on the global stage since taking office 6 years ago. But on the domestic front, economic stagnation is hurting his ruling party's appeal to voters. As South Africans prepare to head to the polls then later this month, Bloomberg's Jennifer Zabasaja takes a look at the president's path to power.
On the day anti-apartheid hero Nelson Mandela was freed from 27 years of prison, he was the man at his side. Cyril Ramaphosa was the future Nobel Peace Prize winner's favorite to succeed him as president of South Africa and the ruling party. But this was not to be Ramaphosa's moment in the political spotlight, as he was overlooked by the ANC. Instead, he became a businessman, acquiring stakes in nearly every key sector of the country's economy, from mining to telecoms to fast food. As a result, he became one of the country's wealthiest individuals. Yet 19 years after the ANC first overlooked him, Ramaphosa returned to politics. Elected president in 2018,
I will be faithful to the Republic of South Africa.
He appointed market-friendly technocrats to his cabinet. The market reaction was euphoric. Ramaphosa had officially arrived. The new president promised to revitalize the economy and root out corruption. But the one-time trade union boss turned millionaire businessman struggled to live up to the economic hopes and expectations placed on him in his first term, even as he looked to carve out a role for South Africa on the global stage. Unemployment sits at 32%, GDP growth hovers at 1%, and the rand has been the worst performing major currency during his time in office. The outcome of the May elections may impact Ramaphosa's market-friendly policies. It may equally define his legacy by way of comparison to his one-time mentor.
OK, Bloomberg's Jennifer Zabasaja reporting there. And Jen will be leading our special coverage of South Africa's elections later this month in our monthly focus show with news and analysis from across Africa. Plenty more coming up. This is Bloomberg.
Apple reported better than anticipated Q2 earnings results, with the iPhone declining about $5 billion on an annual basis, in addition to the same for overall revenue, but the device actually growing in mainland China, according to CEO Tim Cook. The iPad also declined, but that was to be expected given that the device had not been updated since the end of 2022 and that new versions of the iPad Pro and iPad Air are coming next week. Services in the Mac were bright spots on Apple's earnings report, bringing in growth to the iPhone maker compared to the year-ago quarter. One negative was the wearables, home, and accessories category. That fell about $800 million. Luca Maestri, the company's CFO, said this was due to a tough compare from a year ago when the Apple Watch Ultra and the second-generation AirPods Pro saw strong sales in the second quarter of last year. Analysts and Apple executives were all very clearly excited about the prospect of Apple moving into generative AI. Apple plans to announce a slew of new AI features at its Worldwide Developers Conference on June 10th. For Bloomberg News, I'm Mark Gurman.
OK, Bloomberg's Mark Gurman, who is across the Apple story, of course, in all its detail. Just meditate on this, though, for a moment. The biggest buyback in US history, $110 billion being announced overnight from Apple, of course, in its earnings. $110 billion. Now, Bloomberg Intelligence, here's the comparison, by the way, to some of the other buybacks that have come through. Some of the other chunky, sizable buybacks, $75 billion from Chevron, Alphabet coming through with $70 billion. This is a record in terms of the US, $110 billion for that buyback for Apple. Bloomberg Intelligence says the annual returns, shareholder returns from this company are going to average about $100 billion in the next few years. They have a balance sheet, a cash balance sheet of about $173 billion. And since 2012, Apple has returned about $840 billion US dollars since 2012 to shareholders. So the question is, let's flip the board. As the stock languishes, still down 10% year to date, compare that to 70% year to date for Nvidia. Is that enough to put a floor under this stock? And is this stock becoming more of a value stock than a growth stock? So we look ahead to May with the details there around the iPad, and then June as well for its AI strategy. But I think that's a key question for these markets. Is this a value stock or a growth stock? Plenty more coming up. We'll speak to the CFO, the CEO, the Deputy CEO of Credit Agricole on markets today. This is Bloomberg.